Dave Ramsey calls life insurance and whole life insurance a ripoff. In my opinion, gives some of the worst advice to a listener. And not only is Dom and I going to react to this video, but we're also going to show you with math using real life illustrations why Dave Ramsey's not wrong once, but wrong multiple times. Anything that you want to say before we jump in?
Nope. Let's go ahead and jump into it and let's get after it.
All right.
Love some Dave Ramsey fun.
I just have to say, I really do appreciate Dave Ramsey and the message and how he communicates. And this is not a video hating on Dave Ramsey. So please hold your comments because he
actually has a lot of really good stuff.
I really do appreciate how he communicates.
Today's question comes from Jose in Texas. Should I cash in my whole life insurance and get term insurance? No, you should cash in your term. You should get term insurance and then cash in your whole life insurance.
All right, just to start off the video at the very beginning, I say that Dave gives good advice. Here is a prime example of good advice. If you're going to change from term to whole life or whole life to term, always have insurance in place. You don't ever want to go without having protection for your family. In that gap period, something happens to you, that would not be great, right? And this is what Dave is saying right here. Fantastic advice, Dave. Love it. 1+1 for Dave.
+1 for Dave. We'll see how many pluses he gets. But yes, do not have a gap between not having insurance because that could be a horrible thing due to health and who knows what happens.
We have approximately $30,000 in cash value. I'm sorry. We're both 64 years of age. The agent is suggesting a paid-up policy. What is your suggestion? Well, the agent is a whole life agent. And so, you don't let the fox in the hen house and give you advice on this.
All right, so I just have to say it because every time I hear Dave say this, it works me up every time. He says you cannot let the fox in the hen house by saying that the guy is an expert in whole life insurance, so he's giving insurance advice. Well, if I'm sick and I need to go to a doctor, does that mean I should not take advice from the doctor? That's ultimately what he's saying at the end of the day is whoever the expert is, don't take advice from that individual. And I'm not saying that this individual with the whole life guy is giving the right advice by any means, and that every doctor is going to be right, but you should at least listen to all experts and then take those advice and then make your best educated decision. And it's the same with Dave. Dave gives advice all the time when it comes to reducing debt. And if you're in debt, does that mean, hey, because Dave tells you how to get rid of debt, you shouldn't listen to him? No, that's not saying that. Like, Dave probably has some really good advice, but ultimately going into the fox in the hen house is saying that regardless of who the expert is, you shouldn't listen. Like, it just doesn't make a ton of sense.
It's Dave's way of communicating and tearing someone down. He's saying, hey, this person is a horrible human being, and so nothing that they teach you is going to be a good idea. That's what he's saying, because the people that he refers to when they do his 12% mutual funds, they're getting paid when you do mutual funds. Dave has agendas, and does he always give the right advice on debt? Even Dave could probably look back and say, you know what, that probably was not the right move, but he's got an agenda. So it is tough, and he does this all the time with things that he doesn't agree. He like lumps people in and then creates a character war with them. Yep. And it's effective. It's just, the problem is it's just not accurate.
So here's the thing. You have a savings element to a cash value policy called cash value, $30,000. You have an insurance element, which is the life insurance that's paid if you die. The great ripoff of cash value life insurance is that you will never get both, and you have paid for both.
You want to address that now or later?
No, let's address right now. I think it's a good place to start. So essentially, everything Dave actually says is actually accurate, right? He says two things. First of all, he says that there's a death benefit and there's a saving component. When whole life insurance, there is that. There's a lot more other things to that as well.
Yeah.
And the other thing he says, which is the greatest ripoff in all of ripoffs, is that you don't get both the cash value and the death benefit. Now, with that being said, there's truth to that, but it's not the whole truth. And I think what would be great is if we could show you the numbers to really demystify what Dave is actually saying right there. So go ahead, pull up this illustration, and let's this time not click anything.
Yeah.
Let's just hover over it.
All right, sounds good.
What we end up doing last time is we end up clicking and we marked all this over and we had to start the video all over again. So I'm just going to kind of hover around it so we don't make a mess. All right, so there's two components. There's the savings piece that Dave was referring to, which is here, total cash value. This is the savings piece of it. And then there's the insurance, which is the death benefit that Dave was talking about over here. What Dave is saying that when you die, you only get the death benefit. So if you die year one, your family gets $788,000. You don't get the $14,870 plus the $788. Now, with that being said, Dave is correct. That is how life insurance works. You get one or the other. Now, there is whole life insurance that Dave is referring to that you will look in this far right column, and this death benefit will just say $1 million. It'll say $1 million, $1 million, $1 million, $1 million, all the way down for essentially all of the entire policy. So the death benefit never increases. As I'm putting in more money, the death benefit doesn't increase. So ultimately, as I put more money in, I'm getting the same exact coverage for the same exact cost the entire time, kind of like term insurance. So Dave is essentially saying that it's extremely expensive insurance at that point.
And I would agree with Dave Ramsey. We've seen policies like that Dave Ramsey referenced, and they are horrible. And it's almost impossible to justify why someone would put their money into it. Usually you have no liquidity, no cash early on, your death benefit doesn't increase, and it's usually not a flexible plan. It's not a good overall thing. And so for those type of policies, I give Dave Ramsey credit, but what we're saying is like it's frustrating when everything's lumped into one strategy, and why don't you make the point, because I think it's going to be powerful, and I hope that you understand this, because Dave Ramsey has his talking points, and every time he talks about life insurance, this is a talking point, and I hope you understand why he's giving a very deceptive half-truth when he's addressing that they're stealing your cash value. Well, we can address that.
Yeah, and the other thing is too is Dave mentions at the beginning, and I mentioned a comment on it, and bringing the fox into the henhouse, which ultimately, Caleb said, I don't know why anybody would do this. Well, it comes down to one thing: is there's some agents that will sell you it, right? And those agents may not. I don't want to say there's two types of agents. It's one, they just don't know, they may not have been educated, or two, that they are intentionally wrongly selling it because they get paid more money. Right. You get paid when it's set up the way that Dave is talking about it. So it is high commissions, not designed properly. But the way we do it is we try to minimize the cost of insurance. And by minimizing the cost of insurance, we actually get paid less. But by doing so, we can maximize the cash value available in there, which is why we have high liquidity, like Caleb was saying, in control. So with that being said, when we look at this policy, we are paying a total of $20,000 into the policy every single year. So we can see the amount of cash value that it grows by, and we can see that the death benefit that it grows by. If I take $20,000, let's just say in year 3, and I pay a $20,000 premium, my death benefit went up $869 to $849.
Right.
So if I did the math on what that came out to be, it's going to be roughly about $80,000. So ultimately, I put in $20,000. My death benefit went up by $80,000.
Yep.
So ultimately it's saying, am I getting one or the other? I would be better off doing it this way, where the death benefit grows, than getting both when you think about it. So if I only put in 20,
right,
and then I get 20,
right,
well, then that's not a disservice. I'm not getting the max benefit. But in this situation, I'm putting in 20 and get 80.
Right.
I'm actually getting it's like I'm getting the death benefit and the cash value together at the same time.
Right. And this is just early on in the policy. I see $60,000 total you put in this.
Careful.
Yeah, in this scenario, and your policy increased by over 160. Again, like good. we could do math. Like, let's look out over $200,000. Oh, here we go. And the policy, just doing quick math,
is doubled by 700,000.
I mean, little bit less, right? But $700,000 increase. So you tell me, Dave Ramsey's correct. You only get the death benefit, but the death benefit has more than way outpaced the cash value. And the reason why that's strategic, the reason why this is actually a good thing, is death benefits get paid out income tax free. There's a lot of tax benefits to the death benefit versus cashing out your cash value. You wouldn't get that. So there's actually benefits to why you actually want this set up. Anything else you want to do before we jump back in?
No, and the whole reason why that the death benefit does increase is because we minimize that cost so little that the only way to keep putting more money into it is for that death benefit to increase, to prevent it from what's called a modified endowment contract, which Caleb mentioned that you can receive the death benefit tax-free, which is fantastic. But then there's also the benefits of the cash value, where we can have it grow tax-deferred and use it tax-free. And if we prevent it from being a modified endowment contract, we're able to access our cash tax-free as well. And so if the death benefit doesn't increase, then what ends up happening is it becomes at MEC. But by doing so, it grows. The cash value and death benefit become one, essentially, and we are able to still have the tax advantages associated with it.
I love it. Well stated, man. All right, let's jump in.
You paid extra for savings, and you have life insurance. If you die, they're going to pay the life insurance, and they keep your savings. If you cash out the savings, they're going to cancel your life insurance. Now, what is paid up insurance? Prepaid and overpaid. That's what paid up insurance is. You can pay up term life insurance if you want to send them 10 years of premiums in advance. They won't send you another bill for 10 years. It's magical. That's all this is. It's what paid up life insurance is. Because as long as there's a probability you're going to die, which if you're breathing, there's that probability,
That's
then
true.
there's a statistical cost to covering your life. And if the cost never goes away until you die. And so the insurance company is going to get their freaking pound of flesh. Count on it. So paid up and overpaid and prepaid is what paid up life insurance is. So here's the thing. If you take
You want to comment at all?
I sure don't.
Okay.
The problem with the way that Dave explains things is it's confusing. Like, it doesn't make a ton of sense.
Yeah.
Like, you know, us being in the industry, the way that he tried to explain it, like, to me, that makes no sense.
Right.
So
You're going to see a paid up policy, and you're going to see where you're like, okay, I actually don't understand what Dave's saying, because what we're essentially doing is we're dropping the death benefit to a place where it doesn't mech, and our policy will continue to do its thing. And it's crazy that he gives it advice to cash it out, because cashing out could be the worst decision they ever make as it relates to, depending on how their policy's set up. And so it's very interesting. But yeah, I'm with you, man.
Take $30,000 and you put it into a mutual fund, it made 10%, that'd be $3,000 a year. $3,000 a year would buy you a term life insurance policy greater than the one you have today, if you're healthy and could get the insurance. And they are paying you not $3,000 on your $30,000. They are paying you $300 on your $30,000, about 1%, not 10%.
That's probably pretty accurate with the typical policy.
Well, we can show the numbers right now. Like, well, we don't have to do it right now, but we have a policy that we're going to show you,
Right.
to show you what the numbers are in regards to what those are, to show you accuracy.
What I'm saying is, on a typical policy that might not be set up properly, it might not be as good as what we're showing, but yes.
Oh, yeah. And the typical standard whole life policy, a 1%, that's probably
I don't know. Yeah.
good.
So that's their gift to you, is they're giving you 1% on money you should be making 10 or 12 on, and in return they give you a free policy. It's kind of like when I was in Sweden and they told me they had free health care. And I asked them what her tax rate was, and she said, I pay 65% income tax. And I said, tell me where the free starts? If somebody takes money out of one of your pockets and then runs around behind your back and drops it over your forehead, does that mean it's free? This is stupid, okay? This is how we think, though, okay? So it's not free, and it's not paid up at all. You're making a reduced rate of return, and they're using the difference to provide you a toaster to go with your new account you just opened, if you're old enough to remember that at the bank, okay? So, no, it's not free. There is, I got free interest, no interest on my new car, which went down 62% in value when I drove it across the
We'll have a reaction video to his car advice too, but yes.
curb. It ain't free, dummy, okay? You have to think through this stuff. There is no free. Sorry.
I agree with him, by the way.
Yeah.
No such thing as free lunch. Is there anything else that we want to
There's
watch?
not. I mean, you can get free on the short term, but somehow it's being
I think
picked up.
this is a good
So,
place to
Jose, you
to
get your term
essentially stop
insurance.
and to show the actual payout
Okay.
policies now, and so we can explain,
And this is what I'll say is, Dave Ramsey has a good point. He's making good points. The problem is this person already has a policy. So what he's essentially saying is, and by the way, does not understand how we teach life insurance and how it could be an and asset and how it could have living benefits and how it can have he essentially could borrow against that money and have it continue to grow and all that stuff. But at the end of the day, he's recommending him cash out, which there may or may not be taxes due to that, put it in a mutual fund, and then with the interest buy term insurance.
Mm-hmm.
So you tell us after you seeing what we're showing you if that's a good idea or not.
So essentially what we tried to do is we tried to mimic exactly what Dave, said in the policy, that it was somebody who was 64 years old.
Yep.
They had about $30,000 of cash value, and they had to make the decision at that time to cash it out or to essentially make the policy paid up.
Right.
So what we've done is essentially two things. I've done a paid up policy here. This is what this looks like. I've also done a policy over here, which shows the same exact policy, but not making it paid up and keeping it in force. And then we can talk about what the essentially ramifications are if we make this policy, because this is how the policy essentially would have been designed originally by the agent. And then if he would reduce pay it up, this is what it is. And all essentially reduce paid up actually is doing to the policy is, you can see the death benefit here, total death benefit in this column right here, is it has a number at 162. Okay. It's making the death benefit smaller, right? It's reducing it up, which is essentially what's happening, reducing the policy up to where now I have no more payments going into the policy ever again. And that's essentially what reduced paying up the policy is having a life insurance policy that's now in force for the rest of your life till you die, decreases the death benefit at first, and then it increases again because the cash value continues to increase, like we mentioned in the video a little bit earlier, but I never again have to pay another dollar into it. So this is what the insurance agent and the video, in the Dave Ramsey video, is suggesting that he does. Okay, so let's first talk about what happens if the individual decides to just take the policy, take the money, take it cash, and not do this reduced paid up. So we'll come back to here, and essentially it's this policy right here is what it has. I'm not going to reduce pay it up, but I'm at year 7. The total amount of cash value that I put into this policy is $35,000. Okay, so 7 years, I put in $35,000. 7 times 5 is 35. The total cash value amount is $35,592. So the good part about life insurance is essentially that how it works is I can use my dollars tax-free, and I can access it tax-free. It grows tax-deferred, and I can use it tax-free. The second that I no longer am using my policy the way it is designed and I start taking money out and withdrawing from it, yep, I lose all of those tax benefits the second that happens, right? And so ultimately, the easiest way to think about it is my contribution, I'm able to still access tax-free, kind of like a Roth IRA, but anything above that from a growth standpoint, right, we're able to then have to pay taxes on that growth.
And just to be clear, we don't know how the original policy was designed, so we just threw together illustrations, but there's a good chance that this policy, they've probably been paying smaller premiums over a longer period of time, and there is a potential chance that the gain would be a lot greater.
A lot greater.
So in this scenario, if this person cashed out in year 7, they would have to pay taxes on the $592. Mm-hmm. But sometimes you could have 10,000, let's say 10,000 out of the 30,000 is gains. Then that's a taxable event on a greater amount. If their policy would have stayed put, they could have borrowed against it and not had to pay any taxes. And the death benefit would ultimately pay off the loan if and when they die.
Yeah, and there's also some funky tax things as well. If you start taking withdrawals from the policy before like year 12, Brian Shaky kind of talked about it as like keeping the policy in force. Don't ever surrender or take withdrawals before year 12, because based off of like MEC limits and the way dividends are and PUAs are contributed, that you may actually have to pay more taxes on it than even some of your contributions, because it just does a lot of funky stuff to the death benefit and things like that. So with that being said, if you withdraw and surrender the policy, there could be some tax benefits or tax consequences that you're having to pay. In best case scenario, you essentially walk away with the amount of money that you put into the policy at this point, right? So that's the first case scenario. You walk away with $35,000, and that is like, we set this up in the best way possible. And that's saying that this policy actually hasn't been enforced for 30 years and there's higher tax consequences.
I promise you this person didn't get their policy set up like this, but they could have. Right?
Yeah, 100%. So we come back to here. This is now reduced paying up the policy, saying, hey, you never have to pay another dollar into this ever again. And you have a death benefit that'll last you the rest of your life. Dave Ramsey said you should get term insurance, okay? Get term insurance and then cancel your whole life. This individual is now 64 years old.
Yeah.
How much do you think a term insurance is going to cost at 64 years
Yeah, I
old for
mean-
that individual? Are they even insurable?
I don't
Is
know.
another thing to
Yeah.
consider. They may not even be insurable at this point at that age. But I mean, if this individual's healthy and they are insurable, great. $100,000 policy, I mean, it's still going to be pretty darn expensive.
Right.
I would probably say it's probably close to the amount of money that you would have to pay into this.
Potentially. And the other thing that I want to point out is when we look at the rate of return, Dom, we're assuming a 7-year pay. The longer they, quote unquote, hypothetically paid in the policy, the greater rate of return that they would be getting. And so what's interesting is I just want to highlight this because I just think this is so amazing. Let's say they wanted to stop paying. Okay, they wanted to stop paying. Their cash value continues to grow every single year. Their death benefit continues to grow after it initially dropped.
Mm-hmm.
So the big disadvantage of paying up your policy is you're not funding the policy anymore, so your death benefit takes a drop, but now you're no out of pocket. Your cash is continuing to grow. You can utilize it like an and asset, like a bank. Again, this is one of those things that it's like, you tell me where the ripoff is.
Honestly, I can't figure it out. And that's the other thing you mentioned. It's the and concept. Theoretically, if you wanted to maximize the actual cash on it, you could do what Dave Ramsey still wants you to do. You could theoretically borrow against this and you could go do something else with it, such as trying to buy more term insurance
Right.
than you had whole life. Or you could go put it in a mutual fund and go get your 10% somewhere else. Theoretically, you could if you wanted to. I'm not suggesting that by any means or giving advice around that, but you're going to be better off keeping the policy in force because you have an engine that's already growing. And, at some point you can see that the highest IRR in this policy is actually 4%. So Dave mentioned that you were only getting 1%, but this policy is actually designed to, long-term to actually get 4% growth on a policy that you can't get that where it's safe, liquid, controlled, has a death benefit, and you can borrow and use it at the same exact time as it's continuing growing for the rest of your life.
Right. So Dave gave good advice early on. Don't ever have a gap of coverage. I think Dave is speaking to typical life insurance, where I think we all can agree. We could look at typical life insurance and say, and we're going to have videos on this channel, by the way. It's just like, what in the world are we thinking doing this right now? And because we want to be the type of people that call out others for not doing the right thing. And trust me, we have a lot of content to go over there. So we're on Dave Ramsey's side as it relates to majority of the industry. The problem is blanket advice. People hear, oh, paid up insurance is a ripoff and kind of deal. And like literally this person would be better off paying up their policy, utilizing it like an and asset versus cashing it out because there's no money out of pocket. They have a small death benefit that's growing. Their cash value is growing. And if they want access to the cash, they can have access to the cash. Their money will continue to grow. It's one of those things where it's like, we're not even talking about the other riders and benefits that are a part of this. It's just be very, very careful taking straight up advice in a vacuum.
What did Dave say? Dave said, if you have $30,000 in a policy, you're going to get $3,000 every single year. He said, not 300 is what whole life is. Look at it. I have a year. There's $39,000 here. What's happening the following year?
Yeah.
$2,000, $2,000, $2,000. Now we start to curl down a little bit. We're getting almost $4,000. We're getting now more than the mutual fund based off of what Dave is essentially saying. And that's just strictly looking at from even the dollar amount too. And that's also, hey, we're accessing this tax-free. We didn't even talked about what happens when we have to pay taxes on our mutual fund growth as well. And we didn't talk about the fees that come with the mutual fund. There's a lot of things, that's now comparing apples to oranges because they're obviously two different things. But what he's saying isn't completely accurate based off of looking at what we're seeing in front of us right here.
Yeah, it's fair. It's fair for Dave to say, hey, I wouldn't put my money in permanent life insurance, all this stuff, and you can throw shade on all this stuff. But when you're recommending someone cash something out that is already established, what I need you to know is if someone's telling you to cash something out, go to an expert that can tell you the pros and cons to each, that can properly measure the results and outcomes, because you might need to cash things out. I just talked to somebody that actually might cash out a life insurance policy because it was not designed well and there's a lot of problems with it. So I'm not saying overall that's a terrible thing always. It's like you got to know the right scenario and you have to ask the right questions because no product is going to cover all your problems.
Yeah, fantastic. Couldn't have said it better.
All right, comment below, like this video, share it. We're trying to build a movement. We're trying to see 1 million people get life insurance in the next, 10 10 years. That'd be amazing.
Yep.
And so we just thank you from the bottom of our heart for following our journey, for giving us your thoughts, and overall, subscribe if you want to see more videos like this.